hang with it. Now, there's another possibility that you could use to trade this particular situation, and that is if you were fairly well convinced. I mean, now you look down here, you know you have the predicted differences going down, you know you have the predicted neural index at 0, so there are some things that say this market is going down, you know, so you could have looked at this particular trading range that you had set up for the next day, and you could have said, okay, at this particular day, the predicted high in this particular day, you know, might have been a place at which to enter a trade if you could just catch something close to that predicted high. The predicted high was 1141. If you put in a limit order at, let's say, just for sake of argument, about 1139, 1138 and a half, somewhere in there, you could have gotten in on a limit order short. The nice thing about that, first of all, is that it limits the amount of risk if you're using your 1147 that I mentioned before as your exit point. That limits your risk to about 8 or 9 points, which is, you know, a lot better than 18 points. So, you know, it depends on that. But the problem always is when you try to look at how high could the market go, you're kind of doing some guessing. So it's not particularly you know, an ideal type of situation that you're not necessarily going to be you know, so fortunate that the range is going to stay in the parameters that you have defined as the predicted next day high. Now, as I said, we were going to get into this market. We got in at 1129, so you're short now, and you want to be sure that you can kind of hang on, so you are going to just be on the safe side. Once you get this trade going, once you have your stop above this 1147, and as quickly as you can move it down, you want to keep it above the predicted next day high and keep it moving down, you know, trailing stop. Once it gets to the lowest point that it can get to, then, you know, that's where you're going to keep it at that level. You're not going to change it just because it went up on the next candle. You're going to keep it at that lowest point, the lowest predicted high, let's say. So you know that's kind of your safeguard in case things happen. Now we're in at 1129, and when we're in at 1129, we have several ways we can trade it from here. You remember we talked about the moving averages before. If you are looking at that blue line there, you know, as long as it stays there, you are coming down with that trend. No reason to do anything. You can just kind of sit and ride. Other people might prefer, as the market goes down, they're saying, well, I don't want to take a lot of chances. And as you know, with the stock market recently, there's no sure thing. And so sometimes it's nice to be able to maybe take a profit. So you might want to say, okay, I am going to take a profit. If I get 20 points out of this move, I'm going to take a profit. That would be at 1109. Then you might say, okay, I'm going to do the same thing if I get another 10 points. So I think that's right in about there, if I remember correctly from my other chart, at 1089. So if you were in that situation, if you had multiple contracts and were trading 3 contracts at a time, you would have one of them, you would be out at $1,000 profit. The second one, you'd be out at $2,000 profit. Not too bad, and sometimes it's the wise thing to do, I think, because of the volatile situation where the markets go up, the markets go down. They never are going to be, you know, consistently in one direction in any market, no matter what market you're talking about. So then you still have one contract that you would be left with if you were trading 3 contracts. Again, another argument for trading the E-minis as opposed to full-size contracts in those areas and those markets where that's available. Then we come down to a point where the predicted high, right in this vicinity right here, was on this candle, was the predicted high, let's see here, was 1084. Therefore, if you had the market down at 1084, you add your 10 points, you're going to get out at 1094. And so that would not have happened on that particular day on that same candle, but it did happen the next day. So you would have been out at 1094 with that third contract. I know it's not the big gain that you maybe were anticipating, but remember, you've already done pretty well in the first 2 contracts, and this contract itself would have gotten you 35 points altogether if you were short at 1129, as we talked about before. So 35 points, that's another $1,750. And so, you know, nothing wrong with that, because, you know, it's never, you want to let profits run, but it's never bad to take a profit either, because the market situation may demand that you do that. Now there, get to a more current time. We're looking now at this particular candle right here, where we want to talk about the predicted high on this candle here was at 1064 was the predicted high. That means we'd be buying at 1074. As you can see, that candle didn't quite stretch up high enough, but if we keep our I am going to go along because the previous market was up. I should also mention we're kind of skipping this move right in here, this big bar and all that, because normally what happens if the trend is down and they get kind of a counter trend move, frequently that tends to cause people to, it's either not a good trading situation, small gains, whatever, more risk. Probably better to pass that one and wait for the next one in the direction that, that you think it could go after it's had a little time to sort itself out. Markets tend to run down, then they tend to go sideways a little bit, correct themselves, and then they start to make another decision as to which way they're going to go. In this particular case, as I mentioned, on this bar that we had, the candle that we had here, the high was 1064. We're going to buy at 1074. We're going to put our little line right across here. It didn't get hit immediately. Might have taken a couple of candles, a couple of days to hit that point, but at 1074 it would have hit that point, and then you would be long the situation that we had when we were in the market yesterday when the market went up. You have your profit targets and so forth that you can do. In fact, I think you almost could have hit one on this particular bar yesterday, or candle yesterday. I think the high was 1094, so the odds are you may not have gotten out at that point, but you would still be long. You also need to look at what's going on in the rest of the situation. You know that the predicted differences are moving up. You know that the predicted neural index is at 1. So you have some long indicators that you need to be long. You need to be a buyer in this particular market. Again, you need to keep in mind that if you are long and have taken those signals in this particular situation, you want to make sure that you have a stop in place. In this case right here, the stop is going to be, coincidentally, at 1074, where we talked about entering the market, so that if the worst happens, if it turns, the predicted low was 1080, this is as of today, the predicted low 1084, so minus our 10 points, it's 1074, and so if it happens, if it turns, if it goes down, then that means you are going to be out of that market, and if all is well, you'll be out with virtually no loss, other than obviously you have to pay your commission